Welcome to the new era of video creation. With AI stock picking, Palantir goes public after 17-year wait. Here are the contents. Palantir Technologies is a high-profile player in AI and big data analytics. Its software platforms, Gotham for government and defense, Foundry for commercial use, and AIP, artificial intelligence platform, help organizations make critical decisions using massive datasets and advanced machine learning. Gotham is used in defense and intelligence, while Foundry is rapidly expanding into healthcare, finance, and manufacturing. Palantir's strategy of solving complex, high-stakes problems has earned it both a loyal government client base and increasing traction with Fortune 500 companies. In a world driven by AI transformation, demand for secure, scalable analytics platforms is surging, and Palantir is at the center. With over $2 billion in 2024 revenue and expectations for consistent profitability going forward, the company has become a poster child for commercializing cutting-edge AI. However, the stock has always polarized investors, often trading at aggressive multiples during surges in AI hype. With its current price near $124 and a year-to-date rise of over 60%, it's vital for long-term investors to ask not just whether Palantir is a good buy, but when. As of May 2025, Palantir is trading at approximately $124 per share, with a market capitalization around $27 billion. This is a substantial increase from 2024, driven largely by AI sector enthusiasm and Palantir's commercial expansion, especially via its AIP platform. The company is now generating profits and growing its commercial business rapidly. Still, it trades at a forward PE of around 65, which is high even for growth stocks. This implies investors are pricing in sustained, rapid growth and little room for operational hiccups or macro turbulence. Another point of consideration: government contracts, while lucrative, remain lumpy and politically dependent. On the other hand, private sector adoption is ramping up, and management has emphasized recurring commercial revenue to stabilize growth. Despite strong fundamentals, the current valuation includes a lot of optimism. For long-term investors, it's worth considering that entering during moments of reduced sentiment or macro-driven sell-offs could offer a better risk-adjusted return. Palantir remains a high-beta, story-driven stock. Timing your entry can significantly affect your long-term outcome, even if you believe in the business's 5 to 10-year potential. Given current fundamentals, a reasonable entry zone for long-term investors is $95 to $110 per share. This range better reflects Palantir's actual financial performance and gives more room for price appreciation as the company matures. At $124, Palantir is trading at premium levels, priced for near-flawless execution. A pullback to the $95 to $110 range would imply a more manageable forward PE ratio of 40-50x, which, while still growth-oriented, is more defensible given risks. Such prices could materialize during sector rotations out of tech, federal budget constraints affecting government clients, broader macro corrections. Rather than chase a hot stock at its highs, disciplined investors wait for these entry points. That's not just about saving money. It's about optimizing long-term risk-adjusted returns. Buying with a margin of safety means you're less exposed to sentiment-driven drawdowns, which are common with high-momentum names like Palantir. If you're confident in Palantir's future, buying in the $95 to $110 zone gives you exposure while still practicing valuation discipline. It may not feel exciting to wait, but it can be profitable. Buying Palantir at $124 today means buying near recent highs and at a premium valuation. While the company's prospects are strong, such high multiples assume near-perfect execution and uninterrupted growth, both rare in tech and AI markets. The biggest risk? Valuation compression. If growth expectations are revised down, even slightly, the stock could reprice sharply, independent of its underlying strength. This has happened before in 2021, 2022, and again in 2023. Moreover, Palantir still generates a large chunk of its revenue from government contracts. These deals are lucrative but can be inconsistent, with renewals subject to budget cycles and politics. On the commercial side, while growth is strong, so is competition, from Snowflake, Databricks, and hyperscalers like AWS and Azure. A slip in adoption or market saturation could affect future projections. Finally, Palantir is often grouped with AI momentum plays. That can be a blessing in bull markets, but a curse when sentiment shifts. High beta stocks like PLTR can swing wildly with headlines or macro uncertainty. All this suggests caution. Long-term investors should focus not on timing perfection, but on buying quality businesses at reasonable prices. Waiting for better valuation creates flexibility and preserves capital. Palantir is undoubtedly one of the most exciting long-term plays in artificial intelligence and enterprise analytics. The company has built defensible, mission-critical software and is extending its reach into more commercial verticals. But for long-term investors, entry price matters. While the stock has surged on the back of AI hype, that same momentum can reverse just as quickly. By setting a disciplined buy range of $95 to $110, you position yourself to benefit from long-term growth without overpaying. This strategy acknowledges both the opportunity and the volatility. Palantir is not a mature, dividend-paying blue chip. It's still scaling, still building out its business model, and still facing heavy competition. Buying after dips, driven by macro noise, tech sell-offs, or short-term earnings concerns, is a smarter approach than jumping in during peak excitement. Remember, growth investing is about combining vision with valuation. If you believe in Palantir's mission and roadmap, be prepared to act when price and value align.